good afternoon to one and all present here. This is Mohan, Head of Customer Success at Credly. I welcome you guys to this webinar on Personal Finance 101. Hope all of you are able to hear my voice. Well, hoping that. So in today's session, we will talk about practical and actionable approaches, and you will be able to learn the next steps to your health building journey. A few of the topics which will be covered are demystifying finance buzzwords, money mindset, asset classes, asset allocation, insurance, goal setting, power of compounding, model portfolios, and how to save taxes for the current financial year, and demystifying the old tax scheme and the new tax scheme. And this is an interactive session, and we expect a lot of questions from the participants to make it useful to everyone. And our plan is to have an actionable plan by the end of the session. Please write in your question in the chat section. Let me know if you are having any challenges writing your questions. And to cover all these, we have with us today Mr. Balkrishna Billaji, engineer from IIT Kanpur, who has done a course on behavioral finance and investment decisions from IIM Ahmedabad. He is a serial entrepreneur in food, music, artificial intelligence, and technology. He teaches personal finance to kids and to grown-ups. He's also an avid investor. So welcome to the webinar, sir. We have all our participants eagerly waiting to understand personal finance. Sir, I think you're on mute, sir. I'm going to unmute you. Just give me 1 second, sir.
Yeah, I think.
Yeah, we are able to hear you now, sir.
Okay,
welcome to this webinar. We have all the participants waiting for you.
Thanks a lot. Thanks for this opportunity, and looking forward to a great learning and interactive session with everybody.
Absolutely. So, sir, we'll have this session for the next 60 minutes. I'm sure we are going to see all interactive presentations from you. And after that, we'll be taking questions from the crowd, from all the participants.
Yep. I'll strongly encourage everybody to ask a lot of questions. I think one thing is that your questions might be others' questions as well. Absolutely. But as I think I communicated, this session is when you can go home after this session and start on your journey right away. So this is not a theory class, this is a practical class.
Absolutely.
So should I get started?
Absolutely, sir. We're all waiting.
So I'll share my screen. Just tell me if you can. I think you have to enable share screen for me.
I'm doing that, so I'm making you a host.
Yeah.
Just give me a quick second. I have made you the host, sir.
Okay. Yeah. Now I can share my screen. Okay. So you guys can see my screen. Is my screen visible with the first slide? Is my screen visible, Mohan? Okay, I got a thumbs up from Devin, so I'll get started. Yeah, so I think a brief introduction of mine. Graduated from IIT Kanpur long time back. In 1995, did computer science there. Recently went to IIM Ahmedabad to learn a little bit more about finance. I used to work with Infosys, and I was part of the early Amazon team in India. And then I've done fairly diverse things ranging from running a restaurant, making web series, and doing stand-up comedy. So I've tried my luck with fairly diverse things in my career. And currently I run a Concerto AI, which is a conversational AI company. And then I do some work in the music and fake news space, I run a music organization where we do shows for various causes, where we do free shows for various causes. We have been doing this for almost 12 years now. Plus, I run a music magazine, and I also run one of the first fake news fighting organizations in India called Check for Spam. We do a lot of workshops to fight fake news. So yeah, that's pretty much about me. Let me get started. So I'm guessing all of you would be familiar with this, right? All of you would have watched this web series at some point. So I just wanted to bring this. I'm sure you might have seen this web series. And these guys obviously made a lot of money, right? You would have seen all the notes. Maybe in my background, you can see some of those currency notes, although those are Indian currency notes, not Spanish like this web series. But just wanted to explain you one basic thing. These guys also had a path to make money. But as you can understand that this was the entire team, but by the end of the series, I'm sure all of you know who all survived, who all did not survive, right? So we are not talking about making money by taking risks that you are not surviving at the end of it. The whole idea of the session is to tell you how you can make money by taking appropriate amount of risk instead of taking risk like these guys. So that's the whole idea. So it's not just about making money. So whenever people talk about investment, everybody wants to know, can you make 1000 rupees out of my 100 rupees or not? That is not the question we are going to answer. That's a gambling question. We are trying to arrive at a way in which by taking appropriate risk, you can make a good amount of money and meet your financial goals in your life, right? So that is what the focus of this session is. Oops, I think some problem this didn't play, but let me at least tell you the song, which is, let me see if I can see this song. Anybody can recognize this song, which song this is? I'm sure some of you might have seen this movie. So the song goes like, I think the YouTube probably is deleted. That's why. हमरे सैया तो खूब ही कमात है महंगाई डायन खाए जाते हैं, right? This is a song from a movie called People Live. Just to translate in English, I know in English it loses some of its rustic feel, but the whole idea is that you know, as it translates to Hindi, that my lover earns a lot, but the inflation which eats it up, right? So this is what happens with money. Money is not something which is same across, you know, across time. So money always has to be looked at with the concept of time. For example, the house I live in, I bought this house. This is a 3-bedroom house, 3-bedroom duplex house. I bought this like maybe 22 years ago. It costed me 16, 17 lakhs at that point. Right now, I'm very sure that 16, 17 lakhs, you probably won't even get a house in maybe Devanhalli or maybe even far away, right? A typical house will cost you much more than that, right? So always, whenever you talk about money, always understand that it is not just about money, it is about time. Okay, so what was 5 rupees today will become 2 rupees few years down the line, right? So it is always important to understand how much is the inflation and how you have to manage your money with that in mind. Now let us talk about a very interesting concept. You know, I'm guessing that most of you are much younger people, probably in your 20s. I'm very sure that, you know, in one generation, people wanted that, you know, when I'll grow old, my kids will take care of me and they will financially help me. So this equation works both ways, right? Some parents, some kids think that their parents are their emergency funds. So I suddenly need some money for buying an iPhone. I'll just call up my father and say, send me 50,000 rupees. And the same thing works out with some parents, right? They assume that their children's are their retirement fund. Once they grow old, their children's will fund them, right? But I'm guessing most of us in our generation right now, this used to be the system long time back. But nowadays, my assumption is that most of us don't want to be either. We don't want to be the kid who's a burden on our parents. And we don't want to be the parent who is burden on their kids, right? So it is very important that we do our financial planning right away, and we do our financial planning in the correct way right away, so that we don't end up in this scenario either in our early age or in our late age. So before we start with our financial journey, let's just get few things right. Okay. So there are few mindsets which become important for us, uh, to sort of get rid of, right? All of us have some mindset which prevent us from starting our journey of, financial independence or being financially well. You understand, this is pretty much like a visit to a doctor, right? So if you, let's say you are suffering from a fever, you don't ask your, maid servant to tell you that what I should do, right? You go to a doctor. So finance is pretty much like that you ask somebody who understands finance that how I should manage it, and then that person can guide you in the correct way. So first, let us get rid of some mindset issues. So first mindset, which is very common across, I think, especially the younger set of people, is I don't have money. So let me just tell you the counter argument of this. It is not about I don't have money. It is that you might not have a large amount of money. That I can understand. You are early in your stage. You are starting your career. But I'm sure all of you are drinking coffees in restaurants. You are having masala dosa breakfast in a Udupi. So all of you have some money. So one thing you have to get rid of a mindset is that investing or saving money is just like habit, just like your parents taught you that you have to brush every morning, right? It is pretty much a habit like that. So don't worry if you can save 100 rupees today, you might save 500 rupees tomorrow and 1000 rupees day after tomorrow. So start somewhere. It is about building that habit. Don't get into a cycle. I will start investing only when I have 20,000 rupees to invest. Don't get into that cycle. Second thing is, a lot of people say, I don't have time, and that might be true. A lot of you are working 10, 12 hours in office, and then you really don't have time. So the whole idea of teaching you personal finance here is that you don't need a lot of time. You can set up a system in place, which is a one-time activity. And after that, everything can happen automatically, right? And thanks to a lot of technology companies, nowadays, all this has become so easy, right? Means, for example, I haven't visited a bank branch for last maybe 10, 15 years. And I am guessing might be true for most of you as well, right? Nowadays, you can open an account sitting at home. UPI is one of the game changers in India, right? Means my friends come from US and they are astonished by what UPI can do in India, which is not done in, Western economies either, right? So we live in amazing times where you don't need really a lot of time. If you just apply a clear process, you can manage your money pretty well. Third argument can be, I don't have knowledge. That's precisely why we are here, because we want to, give you knowledge, and give you knowledge in a way that is exactly usable by you. Now, the fourth argument is, I don't want money. I'm guessing a lot of you are younger people. Probably you won't have this in mind. But again, money has a lot of applications. If not for yourself, it might be for society, your family members. So there are enough applications of money. The last argument, which you might probably hear from a lot of your parents and probably slightly older people, is I don't gamble. A lot of people look at investment as a gambling exercise. So just wanted to clarify, we are not talking anything about gambling here. We are talking about how you can grow your investments in the correct way and without taking undue risk, right? So somebody might offer you that, yeah, I can, somebody can say that I'll double your money in 1 year, but he has no guarantees, or he's not a trustable guy. That's not what we are talking about here. So now let's talk about one more concept. How much amount of time do you spend in earning money versus figuring out how to manage money? Unfortunately, what happens in our society as well as almost every society is that we are taught how to earn money, right? So when you're young, your parents ask you the question, are you studying or are you not studying? What do you plan to do? Roughly, they are asking you, will you be able to earn a living? And, asking for studies is equivalent to, will you be able to make money to sustain yourself or not, right? So all of us spend our entire time in earning money, but nobody teaches you how to manage money. That's not part of, our syllabus in our courses. In fact, I remember one of our, mutual fund managers, he was talking about, you would have learned one subject in your school called civics, right? Civics is a subject which you'll never use in your any career you follow. But then you should understand that all of us, whatever profession we do, we are voters in this democracy. So it is important for us to understand what is a Lok Sabha, what is a Rajya Sabha, how does our voting work, how does election commission work. So civics is a fundamental subject which all of us have to know, irrespective of we are doctor, engineers, we work in a call center, or we do anything else, we are a content writer. So it is required for everybody. So personal finance is exactly same type of topic. Unfortunately, it's not taught in our syllabus, but it is something which everybody is needs it, right? If you are earning money and spending money, you need to learn how to, manage money as well. Yeah, so we have a lot of either gender stereotypes or age stereotypes. A lot of people have, a lot of spouses say, I don't know about money, I'll let my other spouse manage. Or I don't know my money, but in my opinion, if you are spending money, you are earning money, it is a good skill for you to acquire. And the good part is nowadays it is very easy to acquire these skills. It's not that you have to do MBA in finance from a college to really understand this. These are very easily understandable topics, and all of us can do that very easily. So let's talk a little bit about some broad tips, broad things which all of us should understand in order to understand personal finance. So one thing you should understand is that there is something called as asset and something called as liability. And let me give you a simple definition. Asset is something which puts money in your pocket. Liability is something which takes money out of your pocket. So just to give you a simple example, let's say you buy a house which gives you rent, right? So that becomes an asset because it is generating, or let's say you do a course on artificial intelligence or data science, which enables you to get a job, a better job, which makes money for you, right? That is an asset, right? It can be physical assets, it can be education, can be a big asset, right? You study something and that enables you to get a job which puts money in your pocket, right? Liability is something which takes money out of your pocket. So for example, if you bought an iPhone on EMI, that is a liability because every month you are paying out some 5,000 rupees, 10,000 rupees to pay for that iPhone. So that is a broad, so understand what are your assets, what are your liabilities. Then let us talk about another topic called liquidity. So liquidity is something which is basically how easily can you convert an asset to money, right? So let's take an example here. So let's say if you have a home in Bilekahalli in Bangalore, and now let's say you want to, let's say that home is worth 50 lakhs, right? You are suddenly in need of 5 lakh for some emergency. Let's say there's a medical emergency in your family. You need 5 lakh rupees. And the only asset you have is a home. Now the problem you will face is that you can't sell bathroom of that home and say, I'll take only 5 lakhs out of it. You have to sell the entire home or you cannot sell the home, right? So there are some type of assets which have this liquidity. There are some type of assets which are not that liquid, which are not easily convertible to cash, right? And home is a typical, very, very difficult to convert to cash. It depends on that environment, that area. Can you sell the property or not, right? Those kind of things are there. But let's take another example. Let's say you have a mutual fund or let's say you have a fixed deposit, right? Fixed deposit, you can go to your bank and say, I want to break this fixed deposit, and you can actually get that money straight away, and then you can even partially get in some. Fixed deposit might have a constraint that they might not sell part of the, part of the fixed deposit cannot be broken. But let's say you have 10 stocks of Infosys. You can always sell one stock and get that money, right? So that is something which is a good thing to understand, the liquidity of any asset class. I think somebody has written SIP on the chat. I'll come to that as well. Then there are other things, understanding which is important is that there is an active income versus passive income. Active income is something which you are actively doing. So you go to office, you do some work, and due to that you earn money. That is what is your active income. But let us say you have a property which you give on rent, right? So now you are not doing anything. Let's say you have constructed the house and everything is done. You're not actively doing anything. It generates, let's say 10,000 rupees, 5,000 rupees for you per month. That is something which you are not doing anything actively for that, but still it generates money for you. So it's always a good idea for you to have good active income, but also generate ways in which you can keep earning passive income as well. And that is what we will be talking about in this session. Now, the next thing, I think it's a problem with a lot of youngsters and actually pretty much everybody, that credit card is it good or bad? So my simple answer is credit card is good as long as you don't default on it, right? So you have this buy now, pay later credit cards, which have very high interest rates. Better to avoid them. There are two important things if you want to own a credit card. If credit card forces you to spend more, don't take a credit card. Okay, it's a simple guidance. If it increases your expenses, don't take a credit card. If you cannot pay credit card on time, don't take a credit card. Take credit card only if you are disciplined, if you are not defaulting on the credit card, and if you are not getting into this cycle, yeah, I don't have this money. So a lot of credit card is basically spending your tomorrow's money today, right? That's what credit card is all about. So when you spend your tomorrow's money today, you never become rich in tomorrow ever. You get into a cycle, you have already spent that money, right? So use credit card only if you are disciplined, only if you are not paying defaults, then only you basically use credit card. Otherwise, credit card can give you some cashback points and all those things which are quite advantageous. But most of us get into the other cycle and basically equalize all that stuff. Now, the next important point, I think, especially when you are in Jan, Feb, I know it's some of us wake up in Jan, Feb, March. I don't know if you have seen this data of a lot of mutual funds as well as insurance companies. They do their maximum business in this quarter, Jan, Feb, March, because all of us are sleeping for rest of the year. We wake up in Jan, Feb, March, and we start buying whatever is available. So please understand, tax planning is a entire year exercise. It is not a Jan, Feb, March exercise. Not to say that if you are here and you haven't done it, do it right now, but at least make a resolution to yourself that next year I will start from April. I won't start in Jan, right? And we will talk about exactly about what type of things you can do for tax planning as well. And somehow the budget has come yesterday only, and there is a lot of good news in terms of tax planning for a lot of people. We'll talk a little bit about that as well. Now let's talk about the next concept of emergency fund. So emergency fund is, as the name suggests, emergency fund is something which is meant for your emergencies. All of us can have emergencies, which can be medical emergencies. There might be a industry scenario where people lose their jobs. So it's a good idea, especially for youngsters when they start their career. It's a good idea for you to build an emergency fund for yourself, which is at least 6 times your monthly expense, right? This always gives you cushion on 6 to 12 months monthly expense. At least that's what you should try to keep an emergency fund. And this is something which you should keep on in something which you can liquidate easily. It shouldn't be in, if you buy a property with emergency fund, it might be of no use to you because when you need the money, you won't have the money with you, right? So it has to be kept in something which is very liquid, which can be converted to cash very easily. It can be fixed deposit, or it can be certain type of mutual funds, which we'll talk about. Next thing which is important is you have to make goals. And we'll come up with an exact example of what this means. But it is very important for you to make goals. And goals might be different for different people, right? It might be buying a two-wheeler. It might be education for my sister. It might be something else, investing in a house. Or so all of us have different type of goals, and we'll talk in detail about these goals as well. But it is important for you to make goals. You can't plan for something if you don't have goals, right? Next thing, which is again important, is make a savings plan. Just like you plan to spend, right? You should also have a clear plan on how you will save money. And we'll talk exact numbers here as well. Now, the next thing is get rid of bad debt. Bad debt is all of us, look, one of the things which is important is, this is a common mistake which happens across the board, is we end up buying bad financial products. So I'll tell you examples of some bad financial products. So for example, if you take a loan on credit card will charge you something like, I would say 2-3% per month, right? Which is equivalent to some 30%, let's say, per year. Now, if you get into that cycle of paying 30% interest on amount you have taken on your credit card, it will keep making you poorer and poorer. It's very tough for you to come out of that. Or you might have taken a policy, LIC policy, which is giving you very low returns. So now what can happen is that your money is stuck there. Now, that money you can't get rid of because of, they'll have some things which will tie you in, right? So one important thing in the financial domain is that how you don't buy bad financial products which are bad for you. And we'll take some exact examples on what are the bad financial products which you should stay away from. Track your net worth. This is again a very important exercise. You can do it once a quarter, once a month, whatever frequency works for you. But I'll give you an exact template as well for this. It's a good idea for you to have a clear track of how much is your net worth, right? You keep reading in media, right? Adani is worth so many $1 billion, and whatever Ambani is worth so many $1 billion. Similar exercise we should do with ourselves as well. Our amounts might be smaller, might be few lakhs or whatever the amounts might be. Don't worry about that. But it is important for you to track what is your net worth. Again, we'll talk through a template for this as well. Next, so let me just give you one more interesting thought. I'm sure a lot of you would have used refined oil in your households, right? For frying things or whatever, making some curry. Just tell me this, if the refined oil was called as chemically treated oil, I'm sure most of you would have never used it, right? Since it's called refined oil, your assumption is it is something which is pure, it is something nice for me, although it is actually chemically treated oil. That's what it is, right? Savings bank account is exactly the same. It does everything except saving. Okay. It doesn't save any money for you. It's a typical savings bank account will give you 2.5% return, 3% return. And inflation right now in India is around 7%, 6%. So inflation is double of what return savings bank account is giving you. So if you put 100 rupees there for 1 year, you have become, inflation is 6%, saving bank gave you 3%, you have become poorer by 3 rupees per year. And you will keep becoming poorer day by day. So use savings account to receive money, but always make sure that you deploy your savings account money to appropriate investment things right away. Don't keep too much money in your savings bank account. Then the last point, yeah, this is a mistake which most of us do in our financial journeys, is that we end up buying wrong policies. I'm very sure all of you in your family will have a agent with one of the insurance companies, and then that person will nicely come to you and convince you to buy a policy, will show you some numbers, and he'll confuse the hell out of you. He'll say, yeah, you give 100 rupees 1 year, 100 rupees next year, 10 years, and then you get 1,500 rupees back. And you'll think, Acha, I put in 1,000 rupees, I am getting 1,500 rupees. Maybe this is pretty good for me. So we'll talk exactly about these calculations, how you should judge these policies. So what I'm telling you is that any policy, any insurance policy, which has the name called ULIP, which has endowment, money back, all or assured returns, these kind of policies are mostly bad for you. Okay, so stay away from these policies, and we'll come with some exact examples also here. So one basic concept, let me just explain very clearly again, a stock market concept, which a lot of you might be coming across, is what is Nifty 50, what is Sensex. So the simple concept is that our stock markets typically have 5, 6, 7,000 stocks. Nifty 50 or Sensex is nothing but basically an index, a number generated from the stock price of those top 50 stocks. Nifty 50 is 50 stocks. Sensex is 30 stocks. So this is just a basic thing which you should understand. There's a lot of complex maths which is behind this, but just understand the Nifty 50 or Sensex value basically tells you how the top 50 companies in India are doing, or the top 30 companies in India are doing. Okay, so now let's come a little bit about insurance policies. And I'm covering insurance policies because this is a very common mistake done by a lot of us. So a lot of these policies which we come across will typically give you 5 to 8% type of return. And let me do an exact calculation and show you something. So look at this slide closely. So let us say that you were investing 5,000 rupees a month. Okay. And you invested in, let's say, an insurance policy versus you invested in a mutual fund. Okay, let's take two scenarios, right? So let me maybe try to draw on top of this. Maybe I can draw this, right? Yeah, I know. Yeah, let me just try drawing something on this. Yeah, so if you look at this right here, let's assume that you had bought this mutual fund, which is Reliance Vision Fund, or let's say HDFC Top 200 Fund. Okay. And you invested in 98 to 2017, you invested 5 rupees per month. You did a SIP. SIP is basically nothing but every month you are putting in 5,000 rupees per month. So in 20 years, you would have actually generated something like 1.46 crore or 1.43 crore. That is the amount, right? And let's say you put the same money in a policy, which is one of these LIC policies. The maximum amount of money you would have made is something like 30 lakhs, right? You paid 60,000 premiums for 20 years. You would have made around 30 lakhs. Even if I compare this to the lowest out here, which is 1.43 crore, you can see the difference is more than a crore in in 20 years, right? So what I'm trying to tell you is a wrong financial product can take you back by a very huge amount. It is not that it will hurt you a little. When you take a bad financial product, your loss can run into a very large amount. Okay, it's not a small mistake. That is why it is even more important for you to understand this. Okay. Yeah, let me just come to this mode. And yeah, so few more things which you should understand is, let me just clear this screen. Yeah, clear all right. Yeah. So what if you have emergency? So there are two type of things which can happen is that one thing is you can have a health insurance is one thing which is required. And some of the companies cover a health insurance. You can always add on to that health insurance, but you should plan for your emergencies. Health expenses have become quite big right now, and it's a good idea to have adequate health insurance, right? And other part is emergency fund, which we talked about. That is something which you should certainly keep. In any case of emergency, you can actually utilize that as well. So, but always think of emergencies as well. That's all about risk management here, right? So it's not just about growing your money, it's also about managing these emergencies. Now let us understand a very important concept, and it's a little bit of maths, but it's a very simple maths. A lot of you can do it in Excel without any problem, and I'll show it to you in Excel as well. This is something called as, so this is the way a lot of financial products actually cheat you. So let's take this example. Okay, here what I'm doing is, as you can see, every year on the 1st Jan of every year, I am asking you for 100 rupees. Okay. And then, so 2008 to 2017, every year, 1st Jan, you, let's say, when I say minus 100, I mean that I'm asking you for 100 rupees. And then what I say is on 1st Jan 2020, I give you 1500 rupees. So I'll come to you and say that, 10 years you have paid 100 rupees each. So you have paid me 1000 rupees and I'm giving you back 1500 rupees. So I'm returning you, giving you a 50% return, right? But this is a very, very flawed picture. This is what a lot of insurance agents do with you, right? That they will come and tell you that, yeah, first year you give this much, second year you give this much, and then after 30 years, you get back this lump sum, which is huge, right? This is a typical format of what is given by people, right? So that is exactly the type of thing which you should understand. Here, the absolute returns are 50%, but the actual return, what is written as XIRR, that is actually just 5.39%. So now you understand that actual return of this is, and let's just do this in a calculation in a simple Excel sheet. So I've just made a simple Excel sheet where I've done a lot of these calculations. Let me just show you these calculations. So what you need to do is that you put a date here and you put something in minus if somebody is taking away from you. So here what I've done is minus 1 Jan 2008 minus 100. And same thing I have repeated for 10 years now. Okay. And after that, I have put that in 2020, I get 1500 rupees. Now what you have to do is there is a formula in Excel called XIRR. So here you just have to put this data, B1, B2, this data and this data. And it will tell you how much is the actual return. Okay, this is a simple formula called XIRR in Google Docs. And this will tell you that what is the importance of this time factor. So if you are getting this money in 2020, so 2017, you stopped paying 100 rupees per year, right? So here you are getting money back in 2020. Now let's say if I make this 2020 instead of that, 2025, you are getting this money. Now your return is only 3.26%, right? So as I was explaining you in the other thing, it is very important. Any money, look, we are taught simple interest and compound interest in our school, right? Simple interest, the way it works is very simple, that you have money which goes in at one point, right? And then you figure out from that what is the money you get at after 1 year, 2 year, 3 year. But a lot of financial products you buy are something like this, where the money is going in at different time, right? As you can see here, money is going at 1st Jan 2008, 2009, 2010, right? So this way, a lot of people confuse you. And so whenever somebody sells a financial product to you, ask him the question, what is the XIRR? Don't tell me 50%. People will sell you, agents will sell you 50% returns. You ask them, no, forget 50%. Tell me what is the XIRR. If they don't tell you, you do this calculation yourself. And it's a fairly straightforward way to calculate. Only thing you have to do is put the dates here, put the money which goes out of your pocket in minus, and then 1500 is what you are getting. So that is why it is in plus. XIRR is nothing but, as you can see here, you just have to pass these two things as parameters. That's all. So I know it's a little bit of maths, but trust me, this is one of the most important part of understanding investments. And this is how most of us are fooled into believing some products are good, right? This product might have appeared very good to you because you'll see 50% output. But when I explain you this way, you know it's only 3.26% return, right? Which is lesser than inflation, right? Inflation is 6%. This is like a savings bank account only, right? Okay, so let's get back to these slides. So this is something which I was explaining you in that sheet. Now, another important thing is, which is important in personal finances. I know Corona has taught all of us that life is unpredictable. I'm sure, all of us have lost family members, friends in this entire epidemic, right? So pandemic. So it's important to understand, yeah, you should plan for what if you are gone. So yeah, make sure that you share your passwords, maybe have a shared Excel where you share your passwords either with your spouse or with your best friend, whoever you trust in these money matters. Do nominations in every account. Make sure that all your accounts, whatever bank account or demat accounts have nomination. Then buy term insurance. Term insurance is something which will make sure that in case, especially if you have dependents on you, term insurance becomes even more important, because otherwise your family is dependent on your earnings. So it is very important that you have that. Now let's come to the basic question. How much should you save? We talked about savings plan. So this is a thumb rule, you can say, that I think which all of us should follow. And this is minimum thumb rule I'm talking about. You can obviously save more depending on your life choices. So the thumb rule is that 50% of what you earn will go on your needs. 30% will go on wants. All of us want to have a nice lifestyle. So needs is something which is basic to you, like it might be rent, it might be food, those kind of things. Wants is something which are optional for you. So yeah, you want to eat in a fancy restaurant, that is a want, that's not a need. You want to have a fancy phone, that is a want, that is not a need. But what you should always ensure is that 20% of your money which comes to you, that should go in saving for sure. Okay, so if your salary is, let's say 30,000, 6,000 is the saving minimum you should do, right? And you should adjust your lifestyle based on that, instead of adjusting your, taking credit cards and living on a borrowed lifestyle. Now, let us also understand, when we talk about investments, let us talk about what are the different options you have and what all you can invest. So there are obviously illiquid assets like real estate we talked about. Then there are liquid assets which can be easily converted to cash, are things like stocks, mutual funds. Mutual funds again consist of two types, debt and equity. Debt mutual funds are nothing but just a simple way to explain is, I think stocks everybody understands. So mutual funds which invest in stocks are called equity mutual funds. Debt is like you do a fixed deposit with your bank, right? Similar fixed deposits are issued by a lot of companies, right? You go to your bank, you go to ICICI Bank, they'll give you a fixed deposit which is giving you 7%. But then there are a lot of companies which are issuing similar fixed deposits. So debt mutual funds are nothing but which are buying these kind of fixed deposits, right? Which are not really bank, but Reliance might issue a fixed deposit. Shriram Finance might, issue a fixed deposit. So actually, debt is a much bigger market than equity, but in market, you'll always hear only stocks and things like that. Then there is digital gold, which is again a liquid asset. I don't count physical gold as an asset. Physical gold is something which you consume, you are using it. Otherwise, strongly recommend using digital gold. And even amongst digital gold, there is a government thing called sovereign gold bond. It is something which is issued by the government. That is something which is again, so for example, if the price of gold is 5,000, it becomes, you buy 1 unit of that sovereign gold bond. And then let's say the gold price moves from 5,000 to 7,000, government will give you that 7,000 rupees. Okay, so sovereign gold bond is a great way to invest in gold. Then there is something called as real REIT and InvIT. REIT and InvIT is nothing but like real estate, as I was telling you, is very illiquid, right? You can't sell. So there is a mutual fund type of concept in real estate also. There are companies which basically buy a lot of real estate, or InvIT is for infrastructure projects. And then you can invest even 500 rupees in that real estate, and you will get returns based on the returns they get from that property, right? So it is just the concept of mutual fund applied to real estate. That is what REIT and InvIT do. Then there are digital assets like Bitcoin, Ethereum. 1 year back, I used to get a lot of questions on these things. Should we invest there or not? My strict answer is no. Okay, invest only. And thankfully, nowadays, nobody asks those questions. All these assets have gone so down. So our answer was always no, but yeah, stay away from them unless you are ready to lose that money. And then the last concept which I want to talk about is that there is a concept of weak correlation between asset classes. And let me just explain this to you. So for example, let's say you invest something in stocks and you invest something in gold. If let's say stocks and gold move in the same direction, they go up together, they go down together, then that doesn't manage your risk well, right? So you should invest in assets. What they do is that, let's say if stocks go up, that time gold goes down, and vice versa. So that will reduce your risk, right? So let's say in the current market, let's say if you talk about 2022, stocks haven't really gone up. Means if you look at what was the Sensex or Nifty, Sensex or Nifty in Jan last year versus this year, it is roughly the same. Stocks haven't gone much, but the gold has appreciated by almost 15-20%. Okay, so you should always de-risk. So that way, if you were invested in both of them, you would have had a better return on your portfolio. So Shiva, I see a message by you to explain XIRR. I'll come back to that. I'll come back to explaining XIRR again. Okay, so you should always invest in asset classes which have weak correlation. If they go up and go down in the same way, you don't really reduce your risk, right? So gold and equity is a good example for, especially for last year. Then there's something called as a small case, which is a new player in the market. This is nothing but, this is almost like a mutual fund. Mutual fund, as you understand, is something which combines a large number of stocks together, right? So a small case is very similar in nature. There are some minor differences. But you can invest in a theme. So for example, if you believe that electric vehicles are going to be a big thing, then you can, these are some of the companies which are part of the small case. It's a bouquet of stocks basically. So very similar to mutual funds, but the only difference is that these stocks actually come to your demat account instead of lying with that company. And here, these are the companies which are, sometimes when you look at a domain, so for example, electric vehicle, a lot of us will probably think of Tata Motors as a company which is important for that. But you might not think of Indian Oil, but Indian Oil is doing some work in the space of setting up charging stations instead of petrol pumps. So those companies become, there are people who do research and then figure out that what are the related companies which will benefit from this theme. So this is another interesting option which has emerged in the recent past. Again, in your starting phase, I won't recommend starting with some of these things, but I'm just, so somebody asked me a question. I think there's a question from Salim. So is FD a good option for liquid assets? FD, small amounts is good, but FD should be in very small amounts. There are much better options, Salim, and we'll talk a little bit about them. Means I would rather prefer you stay away from FDs. FDs are, old times, financial products. Nowadays, FDs have become much worse. Yeah, so we were talking about goals. So setting financial goals. Yeah, these are some examples of the goals. So whenever you are talking about financial goals, you should always understand few things about the goal. One thing is, what is your time horizon? What is the amount you need? And then what is the negotiability of the goal? So what happens is that there are some goals which are negotiable, some goals are which are non-negotiable. So for example, buying a car is a very negotiable goal, right? So you might want to buy a 10 lakh car in 5 years, but if it 5 year becomes 7 year, it's not such a big deal, right? You can survive without a car. Or maybe your 10 lakh might become like, I'll buy a second-hand car for 3 lakh rupees, right? So these are negotiable goals. Or going for a foreign trip can be a negotiable goal, right? But then there are some goals which are non-negotiable, right? So let's say your kids' education. You can't tell your daughter that you can't study because I don't have enough money, I didn't save enough money, right? So there are some of these goals which are non-negotiable. So, and another non-negotiable goal which is true for everybody and we underestimated, especially in our younger ages, retirement. Please understand, all of us who are private company employees, or actually nowadays even government employees, retirement is going to happen with everybody, right? So please don't underestimate that this you have to plan right away. You might be in 20s, your retirement might be 30 years away, but that doesn't mean that you don't have to plan for it right away. So somebody's asking, investing money on Bitcoins is the correct option, sir? Yeah, so I think, again, answering that, please stay away from Bitcoins or any of these crypto assets. Crypto is a very complicated technical topic in itself. A lot of techie people like me who are into software and all, we understand a lot of things which go behind this. My simple recommendation is stay away from this. And even if you invest amount which you are ready to lose. So if you are investing for 0.5% of your entire net worth, it's okay. But if you are investing 10% of your net worth, then I'll be really worried. Then there is another concept to decide on, how much to invest where. So there's something called as 100 minus age formula. So what you do is that you invest more in equity when you are much younger. And my assumption here is that most of you are much younger people. So I'm hitting almost 50 now. So as per this formula, I should have 50% in debt, 50% is in equity. But let's say you are 25-year-old, you can have a much higher allocation to equity, much lesser in debt. So I think there are a few more questions. How much is better to invest on digital gold? We'll talk about it. If we are new to investing, yeah, what are we'll talk about the exact portfolio, Roshan. And yeah, so at the end of it, I want you to carry a portfolio. You can, start right away. Any category of MF, we'll talk exactly about that, Sambal. Then there is another approach that you can build a core and satellite. The whole idea is that you build a core portfolio. So let's say you have 100 rupees, you build a core portfolio of 80 rupees, which is relatively in safer things. And 20 is what you can experiment with, right? So this is another approach which a lot of investors use, a core and satellite approach. But they have to build a core because you don't want to, you want to make sure that those 80 rupees are stable. 20 rupees is something which can either go up a lot or, can go down a lot. But at least, so this is another approach which a lot of people use to figure out how their investment should be structured. Now let's talk about another approach which is used for, so look, we talked about various asset classes, right? So now one of the things which we have to do is when we build a portfolio for somebody, you have to figure out how much to invest. Let's say you have 100 rupees, how much to invest in what type of asset class. So this is one simple structure, and you don't have to take notes. I can probably share the PDF of this, that you can, based on how conservative or aggressive you are, you can see in this portfolio that we are constructing it differently. So people who are more conservative, they are investing more in debt and gold and less in equity. And as you become more aggressive, your equity percentage keeps increasing. In fact, in this portfolio, we are even giving you international equity so that you are not just dependent on India. Sometimes this is something which happens across the world, right? Indian market goes down, US market goes up, right? For example, there's a war happening in Ukraine. A lot of people assume that Europe will suffer, but America will gain from this, right? So European markets might go down, but Americans market might go up. And then there's a correlation to India market. So all those things are there, right? So it's a good idea to understand these broad classes and then, then plan accordingly, right? So there's a question, what if, from Amit Bhatt, what if we carry risk at age 40 is higher allocation to equity good? Okay. So Amit, just wanted to tell you one thing. I think I don't have a slide on this, but let me explain you. Risk is a very interesting thing. And risk has two parts. Okay, risk tolerance, what is risk profile of each one of us is very different. And there are two sides of the risk. So for example, let's say your net worth is 100 rupees. Okay, let's make an assumption. Your net worth is 100 rupees. Let's say you actually lost 5 paisa. From a 100 rupees perspective, losing 5 paisa is not, not such a significant amount, right? Statistically or mathematically, it's not a significant amount. So that is one way to look at risk, that whether it is significant in the overall context. But then there is, all of us, our minds are made different. You might be a person who cries a lot even at the loss of 5 paisa, or you might be a person who's not crying even at 5 rupees loss. And that is personal to each one of us. Each one of us are made differently. So whenever you talk about risk profile, it is not just mathematics. It is also behavior of each one of us. So it's a good idea. The biggest part on personal finance, more than finance, is personal, right? And so each one of us should understand what is our behavior. So that is why in personal finance, we always say that it is, I can't, so let's say if I want to make the best rasam or sambar, I can give you, all of you, the same recipe, but I can't do that in personal finance, right? So yeah, even in rasam sambar, you can have different recipes based on Karnataka, Tamil style and Kerala style. But yeah, so that's what I'm saying. Personal finance is very personal, and all of us have different tolerance for risk. So this is another model in which you can understand where you invest how much. And the whole idea of this exercise is, whatever I'm talking about is that you can achieve the same return by taking a lower risk. Okay, so this is not a way, as I was telling you in advance, I have no recipe for telling that how I can make 1,000 rupees out of your 100 rupees in next 2 years. I don't know that. If I knew that, I would have done that for myself. Okay, all I can tell you is, by taking reasonably low risk, how can I make you earn decent amount of money and meet your financial goals in the longer run? These are some examples of, past data in different, so if you look at this slide, I know it's a slightly complicated slide. Here it is talking about how stock and 10-year bond is nothing but, you can call it a representative for debt and gold. So as you can see that in every year, if you look at 2006, 32% return was Indian stocks, 3% return was US stock, bonds or whatever debt gave you 4%, gold gave you 20%, right? Now, if you go to another year, the dynamics is very different. 2008, there was a big stock market crash, right? So stock market gave you minus 52%. US stock market gave you minus 42%. Bond gave you 17%. Gold gave you 16% return. So now you understand why it is important for you to combine all this. If you were just a stock investor, then you will be, in 2008, you will be wiped off. right? You will be tearing your hairs apart, right? So it is a very important for you to understand that to manage risk, you have to allocate money in different asset types. And because that's how different markets move. Okay. Now let's talk a little bit about compounding. This is something which we underestimate, but this is a easy graphic for you to explain, if Albert Einstein, who's probably the smartest guy ever born in the last century, right? Who lived in the last century, I am sure amongst various smart people, Albert Einstein was certainly right in top, right? So if he says about it, you have to trust it, right? So power of compounding is very important. So as you can see from this table, so there's a magic number called 72. It's an easy way for you to calculate when your money will double. So let's say a mutual fund give you, the second column is percentage return. So it's 15, you divide 72 by 15, which is 4.8. What it means is if you get 15% return in mutual fund, your money will double in 4.8 years. Okay. FD, which gives you roughly 6%, now it has slightly increased to 7%, 7.5%. Again, divide by 72 by 6, which is 12. FD will double your money in 12 years. The savings bank account, which I started my discussion with, will take 24 years. And these numbers are not too far from reality. A mutual fund can give you 15%. So just understand the difference. There's a difference of almost 20 years in doubling your money, in keeping your money in savings account versus keeping your money in mutual fund. Okay. So delta of 20 years, that's a lot of life, right? 20 years. So this just to give you an idea how compounding works. And let me just show it to you with another example as well. I think I have a simple sheet to explain compounding as well. So this is how compounding works. I have just taken 100 rupees and grown it at 10%. Look, in the early days, the compounding. So if you look at your 110 rupees in the year one, okay, let's count this as year one, year two, year three. And let's say we are growing at 10%, right? So first 10 years, your 110 rupee became maybe 259 rupees, right? So you gained around 159 rupees. But now look at the next 10 years, your 285 rupees actually became 673 rupees. So now you have gained probably next 10 years, your amount is probably 400, 500 rupees, right? So this is how compounding works. It becomes much bigger if you talk about this. So here per year, you were growing by 10 rupees. But by the time you are done with 20 years, you are growing at 74 rupees per year, right? So compounding, once you spend some years in any financial product, your compounding actually kicks in. Now let's come to the most important part, tax planning. Again, it's fine to earn more and pay more taxes. Sometimes people get very, focused on just saving taxes. But yeah, it's fine if you can, you don't pay tax. But yeah, it's fine to earn more and pay more as well. Do it throughout the year. Yeah, it's an April job. It's not a Jan job. Start in April. Thankfully, what has happened yesterday so let me just go to the next slide and just show it to this. I pulled just from some site, so right now what has happened is that government is trying to take everybody towards a new regime, and they are making the new regime very attractive. So if you have salary up to 7 lakhs, there is no tax. In the old regime, for a 7 lakh salary, you would have paid 54,600 rupees. Now that tax is gone. So as you can see from this, is a simple calculation, tax calculation, using which you can understand that now government is trying to make new regime very attractive. And anyway, they're trying to remove tax they are obviously trying to simplify the tax structure so that a lot of these deductions and all those things are not, that important. But yeah, so there are enough, progress which is happening here. So yeah, tax saving, if you have to invest in something, best option is to invest in ELSS, which is equity linked savings scheme. These are mutual funds which are basically, which have a lock-in for 3 years. So that is the best option for you. And these mutual funds are part of that ATCC, which is 1,50,000 amount limit you have, right? So ELSS is the best product for you to buy, or if you are paying insurance premiums, obviously that also you can use towards that. So that is if you want some extra money besides 1,50,000, then NPS is a good product, although NPS has some problems, or NPS is a long-term locked in thing. But if you are really looking at using the entire 2 lakh limit, but my suggestion is that if your salaries are, in 5 to 10 lakh range, better to move to the new regime and don't pay taxes and don't worry about all these deductions much. A lot of these deductions and all right now make sense only if salary levels are high and you are claiming the entire 2 lakh. So I have some questions. Let me just read up on that as well. So Santosh has a question. Please suggest some growth investment option if majority of amount is already being paid for the home loan EMI. Okay, sure, Santosh, we'll talk about that. Can you please share the Excel for I can share that Excel. Yeah, I can a tax calculation Excel, I can figure out something and send it to you. Can you suggest some good large cap? We'll talk about funds as well, Bani. Okay, so this calculation is, it's just for 3 amounts, the calculation is there, but I know there are enough calculators on internet which will give you complete insight into this. Now let's talk a lot about retirement planning as well. I know a lot of you are much younger people, but it's a good idea to start early. Please understand that life expectancy of people is increasing. So let's say if you stop working at 60, look, there are two forces which are happening. A lot of us don't want to work till our 60, right? I'm sure your parents' generation, everybody worked till 60, 65, right? So a lot of us want to retire at 50, but then our life expectancy is increasing. A lot of us are living till 85, 90 very easily, right? So what that means is that you are going to spend a good amount of your life where you don't have active income, right? And this is the truth with each one of us. You might be 25, you might be 50 like me, but all of us have that same reality. Life expectancy is increasing. So we are, from both sides, it's growing, right? So, and even if your life, you work till 60, most of us will live up to 85, 90. We will spend 25, 30 years when you are not earning. So the simple thing is that we'll talk about a 3-bucket strategy for retirement. So one thing is that out of the 20 rupees I said, right, I told you that 100 rupees, at least 20 rupees you should save. Out of that 20 rupees, at least 5 rupees put in your retirement right away. Okay, don't think of that. I'll start doing retirement planning when I become that, or when my salary reaches that. Plan it right away. And you can use NPS. NPS is open to private employees as well. NPS is something, if you are not very disciplined, NPS is a good tool. If you are disciplined, NPS locks your money, right? So if you are worried that I am the type of guy who will, I have a lot of people in my family, like some of my nieces and all, right? As soon as the bank account hits a certain limit, they'll buy something, right? Some people are like that, right? So for them, it is important to buy financial products which locks their money, right? So retirement planning is required for, and this is a non-negotiable goal. Please understand that. This is not like buying a car or a foreign trip. Retirement is the reality. It might be far away. Sometimes far away, things which are far away are not that clear to us, but they are going to come to each one of us. So what is the return on NPS? That's a good question, Shruti. So what NPS does is, NPS is pretty much like a mutual fund. Okay, so what NPS has done is that It basically has different options, but you can choose how much goes in equity, how much goes in debt. But it is pretty much like a mutual fund. And then there are all the private providers are also part of NPS. So there's a HDFS. You can choose who will manage your money. So like there's HDFC, there's LIC, there's SBI. All these guys can manage your money and they will invest in stocks. So the return will be whatever, how the stock market grows on that. And they have a debt component also, so it can become relatively more stable for you. Which is the best NPS fund manager, Salim? That question. I personally use HDFC. At least at that point when I started, it looked like the better one. But I'm guessing, look, it's very tough to judge which is a good, and their difference is not too much, Salim. So my belief is that stick with one guy. One of the private bank guys are probably much better, and then just stick to them. That will be better. Yeah, I think somebody is commenting ICICI is the best. Yeah, so the private banks normally will operate better. So ICICI, HDFC, those might be better options for you. So again, talking about retirement, I know it's far away for a lot of you, but it's a good idea to understand this concept. It's what is called as a 3-bucket approach. So what you do is that you create 3 buckets of investment. One is a first bucket where you keep money which you require immediately in the shorter run. When I say shorter run, it's 1 to 3 years. Then you have a second bucket which you create for a longer bucket time, which is maybe 5 years up to. And then you create a third bucket, which is much longer term, right? 10, 15 years. So you create these 3 buckets, and as you can say, you can pour water from the third bucket to second to first, right? So that is the way you can manage your money that you create. And these 3 buckets might be just these 3 mutual funds, nothing more than that as well, right? So that is one interesting approach to manage retirement. But anyway, how to manage money after retirement is a different thing. But saving for retirement is something you have to start right away. Now let's talk a little bit about how much money can you make, right? So we are talking about these. So let me just take you to some basic calculators and show you how much money can actually this. And I'll make some assumptions here. So let's say, let me take the other calculator. Yeah, this is a good calculator. So let's say you are at salary of 25,000 rupees. So as I said, 20% you should save, which is 5,000 rupees. So at least 5,000 rupees you have to save. And then let me make an assumption that every year you will be able to grow this by 10%, right? So 10%, yeah, 5,000 becomes 5,500. Then again, 10% of that. And that's how you are able to grow your, assuming that your salary or saving at least grows by 10% every year. Now, expected returns, let's just put a very conservative 12%. And now let us do this exercise for 20 years. Okay. So you can see this example very clearly that you will almost hit a crore. Okay. If you do this very simple disciplined approach, start with 5,000 rupees, 10% grow it every year. Every year I'm talking about. Okay. Assuming you get 10% hike every year, you just grow it by 10 years. And I'm expecting a very conservative 12% return. 20 years you do this. And now let us just play around with this a little. Let's say I grow by 15%. Okay. And then let me calculate my returns. So this is almost 1.3 crore. And now let me just change the number of years, let's say 30 years. This has almost grown up to 6.59 crores, right? So this is the power of compounding. This is the power of discipline, that you can create a significant corpus of money, whereas your starting point was just 5,000 rupees. One argument you might give is that, yeah, inflation will also increase. And, the 6.59 crores might not be worth that much. But yeah, that's true. That's in a way true. But again, inflation is growing at 6%, and let's say you are able to grow your money using stock market or other investment at 15%, there's still a decent delta, right? So this is a good way to calculate that if you are disciplined, if you are consistent at it, you can actually, grow your money quite well. These numbers can become huge. So it's not about small amounts. It is the small amounts with discipline which can make these numbers huge. I'll just go through some questions. If we have PPF, shall we choose NPS, taking the new tax regime? Actually, PPF versus if you are taking a new tax regime, there is no exemption anyway. So then you can take an entirely financial decision, Sambal. There's no tax exemption perspective you have to think through. PPF, the advantage is it is guaranteed. NPS is market linked. So that is the difference between PPF. So my suggestion will be that we will talk about a portfolio structure. Maybe you can have both. So amongst your equity component, you can have NPS. Amongst your debt portfolio, you can have PPF. Yeah, I think somebody pointed out we need to consider time value of money as well. That's true. That is true. But yeah, still 6-7 crores will be a decent amount of corpus in 30 years. And again, inflation will come down as we become more developed as an economy. 20 years back, inflation in India was 10-15%, right? And even the fixed deposit returns were like that, right? So yeah, I think XIRR, we'll come back to that XIRR calculation. I think somebody had asked for CAGR is nothing but the compound interest, which is taught to us in our school. But yeah, XIRR is the important thing which we should understand, especially for financial products, where multiple times you have to pay the financial product. So yeah, so here is what I recommend. Small case you can, so in my opinion, 99.9% of the people can manage with just mutual funds and digital gold. Those are the only two products you need to buy. Rest you can ignore. That works for 99% of the people. Okay. But overall, the products which I also personally use are small case. Don't invest directly in stocks. Invest via mutual funds. And we'll talk about some mutual funds also. In gold, if you want to invest, SGB is the recommended thing. NPS is good if you are not very disciplined and you want to lock your money. There are a lot of FDs, again, keep smaller amounts, but somebody is asking ULIP and I'll answer that right away. A big no, stay away from ULIPs. ULIPs are a big time scam. Okay, and I can explain you how they are, but stay away from ULIPs. And everybody has online apps. So setting up all this is pretty much 5-10 minute job for most of you. Whatever brand you like, use Zerodha, Kuvera, or whatever brand you like, Grow. There are tons of these guys in the market right now, right? So yeah, so this is the overall structure of, the market, what all products are there, that you have primarily 3 asset classes, which is equity, gold, and debt. Okay. And against equity, you can directly buy stocks or you can buy mutual funds. Stocks is something, I would again, stocks are again small, mid, and large companies like ICICI, Reliance. Then there'll be mid-cap companies, top, and then there are smaller companies. Mutual funds, again, there are tons of varieties of mutual funds, and we'll talk about exact what variety of mutual funds you should buy. Gold, we have talked about. Debt again has a lot of different type of mutual funds. So we'll talk a little bit about that as well. So let's just come to a portfolio which will make sense for you. So here is a simple recommendation of what is a portfolio which will make so if you are a busy, lazy, low risk taker, and you can tweak these numbers if any of this changes for you. This is the laziest portfolio I could build for people. This is what I recommend to a lot of my family members as well, who are very lazy. I know that some of my nieces and nephews, they won't have that much time and all that stuff. right? So if you have 100 rupees, so invest in a flexi cap fund. Flexi cap funds are something which invest in mutual funds, which invest in uh, small, mid cap, as well as large companies. So they give you exposure of companies of all sizes. Okay. Then if another rupees 25, you can implement, you can either, if you are using it for tax saving, if you need that tax saving thing, you can, invest in quant tax saver, or there are other tax saver funds as well, which you can invest in. Tax savers obviously have 3-year lock-in. If you don't need that index, that tax saving amount, let's say if you have moved to new regime and you don't need that tax saving amount, then you can invest in an index fund. This is the easiest mutual fund portfolio. Buy one flexi cap, buy one index fund. Navi, for example, has some index funds which are very low cost index funds. Navi has a Nifty 50 fund. You can actually buy that. So it's a very simple structure, 25 rupees each. Put one in flexi cap, put 25 rupees in an index fund. 25 rupees you can put in a debt fund. Here are some debt funds which are nice, and these are more longer term debt funds. So Access Corporate Debt Fund or a banking and PSU debt fund from ICICI. These are slightly longer term debt funds. And then 25 rupees you want to keep in slightly liquid assets, right? So 10 rupees you can put in liquid debt funds. Liquid debt funds are nothing but funds which are, you can count them as replacement for your savings bank account, right? They are very liquid funds. They can be, you can, in fact, some of them have this instant redemption option where within 5 minutes money will hit your bank account. So you can use any liquid funds and they'll typically give you 3-4% return right now. In current environment, around 3-4% return. It won't be very high. You can keep some in FD, smaller amounts, not very huge. FD have a problem, and I think somebody was asking about FD. FD, the problem is that whenever you encash the FD, you pay, the interest is taxable, right? So if you are in higher taxable limits, then it becomes a problem. So you earn, let's say your FD return was, let's say if you are in 30% bracket and your FD return was 6%, 1/3 is taken by the government. So your 6% becomes 4%, right? So FD is fine if you are in not in the higher brackets of taxation. Otherwise, FDs can become a problem for you. Okay. Debt funds are taxed differently. Debt funds, the way they are taxed is, they basically have something in mutual funds. There's something called as short-term capital gain and long-term capital gain. Okay. So short-term capital gain is, just to explain you simply, is that, so let's talk about debt funds. If you sell them after 3 years, they give you something called as indexation benefit. So let me explain you simple terms. What is indexation benefits? Let's say you invested 100 rupees and after 3 years that became 150 rupees. So as per government, you have made 50 rupees on this, right? So now that 50 rupees has to be taxed and that will get taxed whatever the percentages are, right? But the problem is in 3 years, due to inflation, your 100 rupees has become 120 rupees. So you can take indexation benefits and say, my 100 rupee became 120 rupees and my actual cost of debt fund now is 150 rupees. So 150 minus 120 is 30 rupees. So I'll pay tax only on this 30 rupees. So debt funds always have that advantage over fixed. This is something you can't do on fixed deposits. So these indexation benefits are very useful when you talk about debt funds. Okay. And again, SGB, what I recommend here, has one more benefit that government, look, you know, right, that India, I don't know how many of you know, 12% of the world's gold is owned by Indian housewives. I'm not talking about government gold or anything like that, or companies owning gold, just Indian housewives. If some of you are from Kerala, I'm sure you will know this, right? How much gold we own, right? So, so that's the truth. So government wants to, that's one of the biggest import for government. So to discourage people from buying physical gold, government issues this sovereign gold bond, and government gives 2.5% extra in tax incentive on that. So it's a great way to invest in gold. Okay, so this is a simple portfolio you can use if you are, let's say, much younger and you are slightly higher risk taker. You can change that 25 on top to 35 and reduce the other things. So all that you can do, but this is roughly a portfolio you can you can manage with, and you can the build your portfolio using this guideline. So I think there is a question from Shiva. I am at the age 50, would like to save something, and having debt of 45 in my housing loan. So Shiva, just one thing I wanted to comment on housing loan is, uh, I talked about bad debt, but housing loan is actually one of the good debts. It's not a bad debt, because first of all, housing loan usually is low interest, and the other thing is that housing loan is low interest because it is backed by that asset, right? Whatever you have, right? The house, and it gives you some tax benefits as well. Okay, and yeah, I'll mention my email ID. I think that is something I'll pass on to Mohan as well, so that you can please feel free to reach out on any social media channels, email, all that. I think I'll share. But yeah, housing debt is something which you can retain actually. And if you want to plan from right now, I would say that it is better to just build a portfolio like this and get started, Shiva. That would be the best option. Take a stock of your assets right now and start building a portfolio. So that is pretty much the content I had. I'll be more than happy to answer. Yeah, in the end, money does not buy you happiness, but lack of money certainly buys you misery. So happiness, all of us will find in different things, but lack of money is a problem for everybody here. So happy to take questions, and I'll try to share the content and my contact points with so all the Credly users can benefit from this. So any questions, Mohan?
Thank you so much for this wonderful session, Birlaji. I feel very privileged, and I'm sure all of our participants also feel the same way. This was very informative, very engaging. Thank you so much for that. And I think most of the questions that all of us had were asked by our participants whilst the presentation was going on, and you answered them as well. So if we have more questions, participants, please do let us know. We still have a few minutes left in this webinar. And
so I'm seeing a question from Kirti,
right,
regarding SGB. So government issues these SGB bonds around, I think, 5 or 6 times in a year. There are announcements made and almost all media houses cover it. So you go to Money Control or any of these sites, you'll see that, or you can go to RBI site also directly. But you can buy it from the market also. So these sovereign gold bonds can be bought separately as well. You can just go to your demat, whatever your demat is, they'll also, and most of the banks nowadays have a direct way to buy sovereign gold bonds as well. I think there was one question regarding XIRR explanation. Maybe if that is not clear to a lot of people, I can just maybe run through that once again.
Sure.
I'll just share my screen again. I think you'll have to enable the share.
Yeah, I'm enabling that. So. Yeah, there.
Yeah. So this is a simple Excel, and let me go to the XIRR tab. Yeah. So this is a simple that you, any financial product, a date when your money goes out of your pocket, put that out and put it in, plus when it comes into your pocket. And typically, So every year on this day, what is the amount I'll get? Apply this formula, which is right here, right? This is the formula equal to XIRR. This is the formula you apply. And this is telling you the equivalent rate. Look, what is happening is that here people will confuse you with all the numbers, right? That this is 50% return. But your equivalent annual return is actually 3.26% in this scenario. So it's basically a simple calculation of that. Hope this is clearer. Okay, I see few more questions. How much time should we wait before withdrawing from SIP in case it is not giving good returns? So mutual funds, I would say that a mutual fund, look, it's very unpredictable. You should never look at past return of the mutual fund as the only criteria for choosing a mutual fund. There are other criterias as well. You should look at least 1 and 2, 3 years. There are 2, 3 reasons why you should switch out of a mutual fund. One is that the mutual fund manager has changed. Okay, sometimes there is, people have moved to another company and the new mutual fund manager is not doing good. But you should give it 2, 3 years of underperformance before you decide to switch. Changing the folio won't help you in anything. Okay, so let me take the next question from Nirmal. Share taxes rules for long-term investment. How much I need to pay to 1 lakh profit after 1 year? Yeah, you can, Nirmal, you can balance gains against losses. That you can do. So you can, if you are making profit on something, losses on something. I hope you don't make any losses like that. But if you want to adjust in tax, that you can do. Santosh has a question on retirement plan. So Santosh, my suggestion will be don't buy retirement plans. If you just read up a little, understand this 3-bucket approach, you can build your own retirement plan. Okay. So because a lot of these retirement plans in these markets, what happens is, as I was telling you the refined oil example, right? People name their products in a funny way, in an interesting marketing way, and sell you bad financial products. So they'll say, yeah, this is, somebody will come to you, say, this is for your child. And most of us are irrational when it comes to kids, right? So they will convince you that you are a bad parent if you don't buy this, right? And you will end up buying a product which is giving you bad returns. So best thing is do that XIRR calculation. If it is coming to 5-7%, which is roughly inflation, don't buy that product. Okay, because you'll be where you are, right? Are term policies good to take? That's a very good question, Vasu. You should take only term policies, never buy money back policies, never buy assured return policies. So like I was giving you that example of a mutual fund plus insurance policy, right? So if you had taken a term policy and a mutual fund with the remaining money, that would have made you extra 1 crore in 20 years instead of buying a policy which combines. So you should not buy a policy which is saying this is investment as well as insurance. Buy insurance separately, do investment separately. So Vasu, good question. Yeah, buy only term insurance. Never buy these combined products. Peer-to-peer lending, is it safe? A lot of ads coming on the net. Nirmal, stay away from that. Not a very good. There are some P2P platforms. I also use some of them, but yeah, I think that that area is still not regularized by the government. So better to stay away from P2P lending sites. Which is the present investment you feel will grow apart from gold? Equity will grow, Nidhi. I think you have a question apart from gold, what will grow? I think stocks will grow. India has a lovely story. This decade belongs to nobody. I mean, I have no doubt this decade belongs to India. Means there are entrepreneurs like Devendra, all of you part of the startup, right? There are guys like this who are changing this country, right? And this type of excitement and especially a lot of you who are in the fintech space. Trust me, we have a lot of friends living in, I'm sure Devendra also has a lot of friends living in US. When they come to India, they are astonished what is changing in India, right? So Indian equity is a great place to invest. India will grow by many fold in next 10 years and you will grow along with it. Please understand, stock market investment is about growing with the country. Okay, so Santosh, okay, Kirti, which tire is good for NPS? So Kirti, tire 1 has basically tax advantage. If you want to use the tax advantage, use tire 1. Tire 2 is not worth it. It's just like any other mutual fund. So you might as well buy any other mutual fund, So tire 2 is not worth investing in, Kirti. Right? Hope that answers your question. So any other question? And please feel free to reach out to me. Means I'm there on social media, Twitter, Facebook, LinkedIn, whatever medium works for you. Email and all I'll share with, I think PPT and all those things more I can share with you and maybe you can pass it on to the folks. But yeah, feel free to reach out to any of the social mediums. I'm quite active on almost all the. So I have another question from Bani. How to buy dream house? Okay, what's your best house buying tips and please suggest best health insurance? Look, house is something which most of us will end up buying via loan, Bani. So I think that's perfectly fine. Dream house, I don't know. All of our dreams are very different. On what dream house means is different to each one of us. But yeah, you have to optimize between the distance from the main city versus, travel time and things like that. Given infinite money, obviously we'll buy on MG Road, but that's not possible for a lot of us. So yeah, but we will have to end up taking loans for the housing part. Start saving early. That's all I can say, Bani, and try to grow your money at least at 15% range, and then you will be able to afford that dream house. Health insurance. I don't think I'll recommend a company as such here, but I think the typical things to look at is look at hospitals around you. That do they have cashless there? Health insurance amount. Easy way to decide is in your city, you figure out how much a heart surgery cost. At least that much health insurance you should have. That's the easiest way. Heart surgeries cost very different in different cities. Like in a place like Bangalore, you can do a heart surgery for maybe 4-5 lakhs. In smaller cities, maybe you can do it for 1.5 lakhs. That's a good thumb rule to follow. If lump sum amount, where to invest? Daya Sagar, that's a good question, Daya Sagar. Lump sum, never invest in equity in lump sum. Always spread it across. Let's say if you have a lump sum of 1 lakh, 2 lakh, invest it in installments of, divide it into 10 to 15 installments. Stock market, you should never do lump sum investment. Divided in 10, 15 across 10, 15 months. And in that time, you can keep it in a debt fund. So you can invest in a liquid fund, and from liquid fund, you can keep transferring to the equity fund every month for next 10, 15 years, 10, 15 months. Taking home loans from LIC is a good idea. Yeah, LIC used to be a fairly competitive loan giver. In fact, I remember taking a loan from LIC. The home which I live in actually was taken from LIC. But this is a simple interest rate comparison, Nitin, that, if interest rates are good, you take it from anybody. And plus, obviously, what is easy for you to manage, yeah, LIC is quite competitive in terms of interest rates. I don't know. I took these loans long time back. So currently, I don't know what housing loans, who are the good guys right now. But it's a simple interest rate comparison. So I guess I don't see any. Okay, please make me the host. Okay, I have to make. Okay, just give me. How do I make you the host? Okay. Yeah, got it. Yeah, I changed the host one.
Thank you. I wasn't able to talk. Thank you, sir. Thank you so much for that. So this was very, very informative, and I'm really glad to see that we had a lot of questions even after the session was over. It was very, very interactive. I thank all the participants as well for making this very interactive, and I'm sure these were all of, all of us had the same sort of questions in our minds as well, and somebody asked and we got answer for the questions.
Right.
And we also thank you, Bilaji, that you said that you'll be sharing the presentation with all of us as well. So I'll be forwarding that with everybody who attended this webinar today.
Sure.
So we'll surely make use of your presentation for all the future planning. So yeah, that was very informative. So I think we'll wrap it up, Bilaji. And there are no questions.
Yeah,
so,
I think.
Right. Thank you so much, everyone. Bilaji, any last words?
Oh no, just one question I saw from Kirti. I'll answer that.
Okay.
We don't invest in real estate is not a very good way to, unless you have some asymmetric information about property prices growth in any city. Real estate is giving very low returns nowadays. And plus it is illiquid, Kirti, so better stay away from that.
Sure.
So that's it. I think I've answered all the questions.
Right. Thank you, Bilaji. And to all of you, this webinar is recorded and this will be shared. We'll be publishing this on our YouTube channel. So if you wish to, relook at this webinar to understand a few things that Bilaji discussed, you can go to our YouTube channel and you can watch it. And please do reach out to Bilaji, as he mentioned. He's available in all social network platforms. You can reach out to Credly as well. So if you have already invested in the things that Bilaji mentioned, if you want that to be added in your Credly account, please do reach out to us. So we have everything automated in the system. We are a complete automation of all of these things that Bilaji mentioned. Reach out to us if you want more information about it. So yeah, thank you all so much. Thank you, Bilaji. It was very informative. We would like to connect with you again for such a session. So a lot to learn from you. Thank you, sir. Thank you so much.
Thanks a lot. Thanks, everybody.
Thank you, participants. Thank you so much. Namaste.